All right, let's get right into it. Today we are doing a technical deep dive into one of the trickiest, most fought-over parts of real estate tax law. We're talking about the Section 121 exclusion, but specifically how it applies, or more often, doesn't apply, to selling vacant land. The IRS is watching these deals like a hawk, so we're going to break down exactly what triggers what I'm calling the land audit and how to navigate these really intricate rules.
Okay, so what's at stake here? This number. For married couples filing jointly, it's a $500,000 gain, completely wiped away, totally free from federal income tax. I mean, Section 121 of the Internal Revenue Code is, you could argue, the single most powerful tax benefit for homeowners out there. It's designed to protect a lifetime of equity you've built up. It really is the gold standard. But here is the question that's literally worth hundreds of thousands of dollars. What if you subdivide your property? You sell off that empty lot right next to your house, but you keep living in the house. Seems simple enough, right? Well, this exact scenario is what triggers the land audit, a very focused IRS review that's specifically designed to challenge this kind of transaction.
So, here's our game plan for getting to the bottom of this. First, we'll talk about the financial stakes involved. Then, we're going to dissect the absolute core of the law, what we'll call Section 121's dwelling rule. From there, we'll look at the very specific, very narrow vacant land exception, see how it played out in a huge court case. And finally, we'll reveal exactly how the IRS flags these sales in the first place.
So first up, the high-stakes land audit. I mean, why does the IRS care so much about a patch of dirt? Well, it's simple. Because that patch of dirt can represent a massive, massive tax bill that, let's be honest, people are highly motivated to try and avoid.
Let's just look at the numbers, because they tell the whole story. You have a qualifying home sale with a $500,000 gain, you pay $0 in tax. Zip. But if that same $500,000 gain comes from a land sale that doesn't qualify, suddenly it's a long-term capital gain. And after you factor in federal and state taxes, you could be looking at a bill for around $169,000. That huge gap is the entire reason the land audit exists.
You know, the root of the problem is just a fundamental difference in how we see things. You look at your property, you see your house, your yard, your garden. It's one cohesive thing. It's your home. But the Internal Revenue Code, it slices it in two. It sees a dwelling unit, the actual physical structure, and it sees the land. And all those great tax benefits, they are tethered to the dwelling, not to the dirt itself.
And that brings us right to the law itself, Section 121's dwelling rule. You really can't understand the audit unless you understand the law it's designed to enforce. So believe it or not, it wasn't always this way. Before 1997, the law was under Section 1034, and it lets you defer your gain. You could just roll it over into a new home. The rules were a little more flexible. But then the Taxpayer Relief Act of 1997 changed everything. It got rid of the deferral and replaced it with a hard, permanent exclusion under Section 121. And listen, to justify literally giving away up to $500,000 tax-free, Congress had to get much, much stricter about what exactly qualifies. And this is it. Section 121A lays it all out. To get this incredible tax break, you have to pass 2 tests in the 5 years right before you sell. First, the ownership test. Did you own it for at least 2 years? Simple enough. But second is the use test. And this is the one that trips everyone up. You have to have used the property as your principal residence for at least 2 years. Sounds easy, but think about it. How do you use a patch of vacant land as a residence? And that's the legal minefield we're walking into.
This is probably the best analogy to get your head around this. That use test is all about living somewhere, about occupancy, and you can't occupy dirt. So the IRS and the courts look at it like this. The dwelling, your house, is the sun. The land around it is just a planet. That land only gets its residential character, its tax gravity, you might say, from that sun. If you take away the sun, the planet goes dark. It loses its special status.
Now, there is an exception, but it is incredibly narrow. And to understand it, we need to pull out the magnifying glass and look at the specific rulebook, Treasury Regulation Section 1.121-1B3. The regulation gives us a 3-pronged test, and this is critical. You have to meet all 3 conditions, no exceptions. 1, the land's got to be adjacent to your house, obvious enough. 2, you have to have actually used that land as part of your residence. Think of it as your backyard, not some investment lot down the street. And 3, this is the one. This is the absolute deal breaker.
You must sell the dwelling itself within 2 years, either before or after you sell the land.
And here are the exact words from the regulation that an auditor is going to point to. It's totally unambiguous. The sale of the dwelling is the anchor event. If you sell the land but you plan on staying in your house forever, you fail this timing test. The exclusion is gone. This is, without a doubt, the most common trap people fall into.
And of course, the regulation is way ahead of anyone trying to get clever here. It also prevents you from trying to double dip. If you do everything right and sell both the land and the house within that 2-year window, the IRS just treats it as a single event. You get one exclusion capped at $500,000 for the whole shebang. You can't get one for the land and then another for the house.
Okay, so we've looked at the theory and the regulations. Now let's see how these rules play out when there's real money on the line. This brings us to a huge case, a landmark precedent, Gates v. Commissioner.
So here's the story. The Gates family buys a home in California. They live in it for 15 years. So far, so good. They've easily met the use test for that original house. But in 1999, they decide to upgrade. They tear the old house down completely and build a big new one. And here is the crucial fact, the one that cost them everything. They never lived in the new house, not for a single day. They sold the whole property a year later and tried to claim the exclusion.
And this table just breaks down their catastrophic failures step by painful step. The second they demolished that old house in '99, they literally destroyed the one asset that qualified for the exclusion. The property became vacant land and it lost its residential status. So when they sold the property with the new house in 2000, they were selling an asset they had never used as a residence. They failed the use test, period. The result? Their entire gain, nearly $600,000, was 100% taxable. Ouch.
So the takeaway from Gates versus Commissioner could not be clearer. The Section 121 exclusion is attached to the specific dwelling that you actually used. The court's holding was that once that qualifying house was gone, the residential history of the land was wiped clean right along with it. Demolishing the house was, for tax purposes, the same as demolishing the exclusion.
Okay, last section. Let's pull back the curtain and see how the IRS actually enforces this stuff. This isn't random. It's a very data-driven process designed to find these exact transactions.
So here are the main triggers. First and foremost, the IRS has automated systems that match up a Form 1099-S, that's the form that reports the proceeds from a real estate sale, to your tax return. If a 1099-S comes in coded as vacant land and the computer doesn't see any corresponding gain on your Schedule D, that's an immediate red flag. Second, auditors can easily pull local property tax records. If the improvement value on the record is 0, they know it was a land sale. And yes, they absolutely use satellite imagery to check if the land was truly adjacent and use this part of the home.
So after all of this, the lesson is crystal clear. The Section 121 exclusion is a benefit for your home, not for your land. The land only gets to ride along and get that tax benefit when it's sold as part of that home, or within that very strict 2-year window we talked about. The dwelling is the anchor for the entire exclusion.
And that leaves us with one last question to think about, especially for the professionals watching. Now that you understand that the dwelling is the anchor that holds this entire massive tax benefit in place, how does that change your strategy for clients who are looking to subdivide or develop their property? Because as we've seen, the timing and the structure of that transaction, well, it's everything.